Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, stocks look to close out a week of record gains. How will the Fed's path forward affect that rally? Plus, homebuilder Lennar falling after its forecast highlights headwinds for the sector. We'll have more on that ahead. And Intel downgraded after NVIDIA struck that $5 billion deal with the company. Why? What's behind that downgrade? We'll have more on that in today's top analyst calls coming up. First, let's get a check of the markets here. And if we take a look at what's going on, the Dow pushing slightly higher. Remember, any gain today will be another record close for the Dow, the S&P, the NASDAQ, and the Russell 2000, which hadn't seen a new record since 2021. So we'll see what happens. Today is so-called triple witching, expiration of futures and options contracts. You tend to get a little more volatility and volume, particularly at the open and close. So we'll see what ends up happening through the day. Right now, it's just modest gains, up about 50 points on the Dow. The S&P 500 up almost 0.25%. The NASDAQ gaining the most, up about 0.4. The Russell 2000 is actually in the red today, at least for now. So it looks like it is not going to reattain that record. And just going back to the S&P 500 for a moment, just wanted to look at what we have seen on the week here, because it has been this week of records. Of course, the big move upward here that we had when the Fed came out and cut interest rates and seemed to indicate that more rate cuts are coming. So that then pushed things higher. As we look at what's going on the sector level here today, we've got consumer discretionary and tech as the two best performers. They have been on a run. Consumer discretionary in particular has been running not just today, but we've seen it running higher, really through a little bit sideways this week, but up 1.5%. But the year to date on this group up about 8% at this point. By the way, it is also trading near new records. Looks like it's not quite there again today, but close to that level. And let's look at large cap tech with the NASDAQ leading here today. Most of the Magnificent Seven in the green, it looks like here. Apple, remember, its new phones going on sale today. It's up 1.25%. Tesla getting a couple of positive calls. We'll have details on that more later, but it's up about 2.5%. Well, the Federal Reserve cutting interest rates for the first time this year in what Wall Street is viewing as the beginning of a rate-cutting cycle. However, the question remains whether the Fed is cutting into a hard or soft landing. Joining me now for more, Carrie Freestone, RBC Capital Markets economist. Carrie, it's good to see you. So how are you and the team viewing the Fed's cutting cycle and how it's going to play out for the remainder of this year?
This is a great question. So the market is very much still digesting a very complicated meeting this week. And, if anything, we got the signal that when both sides of the mandate are increasingly in tension, labor is going to be the side of the mandate that the Fed is going to favor for now. They were lucky that the data over the past few months did permit them to cut this time around, but they're going to face increasing challenges in the months ahead. Now, we are expecting to continue to see at least one more cut this year, if not two. Our call is for 5 cuts ahead, and I think that's pretty much in line with the market. But the question is, as we start to see inflationary pressures build, what is the Fed going to do with that, and how are they going to be able to continue to justify these cuts? And so the data is going to continue to be more challenging.
So as you take a step back and look at what the biggest challenges are in the U.S. economy right now, are you seeing it more on the inflationary side? Are you seeing it more on the labor side? Is it both? And, how is that going to develop in the months ahead?
So far it is both, but if it were up to me, I would say that I am quite concerned about inflationary pressures building, because that's something that, we're starting to see, but we haven't yet seen the full extent of it. And take tariffs aside for a second. Everyone's talking about tariffs, but I think we also have to talk about the fact that, the Fed was going to be hard pressed to see the inflation reach their 2% target this year, even in the absence of tariffs. And there was a few reasons for that. Firstly, we're losing out on the benefit of core goods deflation, and that's just base effects falling off. Secondly, we have these structural changes in the labor market. We have labor shortages from a structural standpoint because of record retirements, now more stringent immigration policy, and that's meant that wage growth has been quite solid. So that is going to put a floor on services sector inflation. And the third point is the OER component of the CPI basket as well.
Owner's
equivalent of rent, yes. And so that's something that we track, and we look at data from the National Association of Realtors for home prices. Typically, OER data follows the National Association of Realtors data by about 22 months, with a 22-month lag. we're at that point now where we should start to be seeing an uptick in OER, and we actually did see that in August, and that's something that we expect to play out this year. So now we're at a situation where we're seeing services sector inflation and goods pressures mounting in tandem, and that's going to be concerning for the Fed. And now tariffs enter into the discussion, and there's a lot of question about when the data is going to show the impact of tariffs, and I've heard folks say we haven't seen it in the CPI data yet, so we're not going to see it. I don't agree with that. I think we know that there's significant months of inventory building. Those inventories have yet been depleted, and once they are depleted, we're likely going to see the pass-through start to happen. So we expect that'll take place into the fall. Our forecast calls for core inflation to reach 3.4% by year end, and at 3.1, we're at a pretty uncomfortable starting point.
So all of that says to me, you expect the Fed to cut 5 more times, but that there are risks to that. So in other words, there's what they're going to do, and there's what they should do.
So I think it goes without saying that we are in a data-dependent environment, and we're also in a low-conviction environment because there's so many uncertainties with the data. We have a ton of black holes. We don't really know how many months of inventory builds we have. That data has been increasingly problematic, and it's difficult to see. And it depends on a sector-by-sector basis as well, how fast this inventory depletion is going to happen. At the same time, we are seeing the labor market soften. And during the last Fed meeting, we hadn't gotten those NFP revisions just yet. We thought that over May and June we'd added over 200,000 jobs. Turns out only 6,000, and so that's a pretty sizable differential. And I know we're saying that job growth has remained robust in some areas, but I think it's really important to separate the cyclical from the structural here. The majority of job gains are happening in healthcare and social assistance hiring. That's not a cyclically exposed sector. And if you look at trade exposed sectors, the goods sector is shedding jobs, and the services sector is hiring, but it's very weak. So that is something I'm concerned about as well. There are two sides of the mandate that are going to be increasingly in tension.
So in other words, you don't necessarily think it's a mistake that the Fed is cutting, even as you think those inflationary pressures are persistent?
So it's not a mistake just yet, but I will say that it is going to be increasingly challenging for them to justify cuts as we start to see inflationary pressures materialize. The other thing, Julie, that I want to talk about is, we're in a situation where the economy has very much changed. We're in a less interest rate sensitive economy. And the question for me is, what are these cuts going to necessarily do? If we have 25 basis points or even, 75 basis points worth of cuts this year, we have structural labor shortages, we have tariff shocks, and we have geopolitical forces beyond our borders. Interest rate cuts aren't really going to do anything for that. Now, they will help lower income consumers who are carrying higher debt burdens, but we're in a situation where the economy is becoming less and less interest rate sensitive. So it's not clear to me whether we're going to see, these cuts or this move towards normalization actually materially boost economic activity. We're looking at sub-trend growth, and I think regardless of whether we see cuts or not, that's going to be a reality.
Interesting. All right. Well, we'll have to pick up on that last theme last time. I think that's really interesting that cuts are not as stimulative, perhaps, as they once were. Carrie, good to see you. Thanks for coming in. Coming up, how one Lennar shareholder feels about the recent slowdown in home building and what he thinks you should do with the stock. We'll be right back. Shares of Lennar taking some losses after reporting lighter than expected revenue in the third quarter and a disappointing outlook for the fourth quarter. The homebuilder calling out a 9% decline in home revenue as well as narrowing margins due to lower average home prices. Joining me now for a closer look at the home building sector, Bill Smead, Smead Capital Management CIO. Bill, it's always good to see you. You are a Lennar shareholder, and I know in general you like home building stocks. What do you think about these results in particular?
Well, they're what you get from what came before. And of course, stock market participation always looks out 9 to 12 months. We've looked back over the last 40 years. It's a good time to buy the home builders when home builder sentiment is low. And home builder sentiment is low right now because of the difficulty that they're dealing with right now. But there's a completely separate story that's going on that people aren't paying close attention to. We just checked right before I came in here. D.R. Horton and Lennar do 40% of the revenue in the entire industry. So what happens when you get in a difficult time, this company can keep chugging along, building and selling 20,000 homes. And what they're doing is they're going to take market share away from everybody else. And so think of it like this. Horton and Lennar are a bit like Costco and Walmart. Horton is the lowest priced builder of a home in all 36 states, and Lennar is huge nationwide. So they're like Costco and Walmart. Do things get difficult in retail once in a while? Of course they do. But has it paid to get out of the companies that end up completely dominating the retail category? And the answer is no. So that's where we are. And this is much harder on everybody else than it is on these two companies. They've gone land light, meaning Horton has 76% homes built on someone else's lots, and Lennar is 81%. And then we also own NVR, which is 100%. So they don't have much capital tied up in the building. They're making a lot of money, even though it's not as much money as they were making when things were better. And then when things get better, they'll have more market share, and we'll have another wonderful era. And there are 180 million people under the age of 40 in the United States.
Bill, when do you think things will get better?
Actually, stock-wise, the stocks have a tendency to start anticipating what we're talking about. And the truth of it is, Lennar's higher than it was 2-3 months ago, and so is Horton. So they just had a pretty good stock run until a week or two ago. Again, so it's all an anticipatory game, and this industry used to be highly cyclical because they used to borrow money to develop lots. And then when the market would turn sour, they not only had homes they couldn't sell, but they had a whole bunch of lots that they had borrowed money attached to. And now these companies have pristine balance sheets, Jamie Dimon fortress-like balance sheets.
So, Bill, this is just one area you like, of course. You're a longtime value investor, student of Warren Buffett. I'm curious more broadly. You know, we have seen some chatter around value more recently. What do you think the setup looks like right now? Because we have seen that outperformance of growth for quite a while now.
Yeah, your economist, prior guest, I did a wonderful job of laying out what's going on. We're in the camp that thinks that inflation will be stubborn, and therefore we expect at some point in time this incredible mania, this bubble that has now been exacerbated by the race for AI. When it breaks, there's going to be a lot of heartbreak because the S&P 500 is completely twisted up in the game, and that is a big problem. When you've got this much concentration in the stock market, I'm reading about 1920 through 29 right now, and it wasn't NVIDIA then, it was RCA. And I just read eBoys, and eBay is a stock we own and have done very well on, but it went from 18 offer price to 648 when it went public. And I made a lot of jokes about them, except that I really liked the business that they created, which I call the New York Stock Exchange of prior owned goods. So anyway, so we think inflation's going to be a problem. And then secondarily, we think that only so long can the president's effort to jawbone the price of oil down affect the inflation statistics, because the industry is not going to poke holes in the ground, and the Permian Basin production is going to decline, and we're the largest producer at the margin the last 10 years, and then oil prices are going to rise. And that's just going to add to the inflation that the young lady was mentioned there.
Bill, I also want to ask you about another holding in your portfolio, because there were some headlines on it recently. I'm talking about American Express, which just increased some of its fees, which got some headlines here. How do you think that one is positioned? And is it a beneficiary of the so-called K-shaped economy, where the wealthiest Americans still seem to be chugging along?
it's a very unusual circumstance. We have the wealthiest 55 to 80-year-olds in history. That's who owns most of the stock. That's who owns most of the S&P. That is the largest position in almost every asset allocation model of almost every, not only US RIA, but around the world. So no question about it, American Express is positively affected by that. I happen to have both a personal and a corporate American Express card, and you can guess I pay no attention to what they charge each year, and use it a lot and use the points. And it's very popular among the heavy traveling 25 to 40-year-old single people that have waited a lot longer to get married. I often joke about the fact that in 30 years, the best stock to own in the United States is going to be a nationwide set of psychiatric centers that deal with the fact that today's 25 to 40-year-olds are going to be 55, and they've gone to every destination that you would have wanted to when you turned 55, because they've already been there in their 20s and 30s, 5 times to Tuscany. So American Express is in a good spot, but I'll remind everyone, we bought the stock when they divorced Costco as the branded credit card at Costco. And people thought that was the end of life for American Express. It was 10% of their credit cards, but they weren't making any money on those credit cards. They were, you would call them lousy customers from a profit standpoint, but good customers from a PR standpoint. The stock went from 93 to 73. We bought some. It went to 64. We bought some, and it bottomed out at 55, and we ran out of money.
Well, I guess it turned out well in the end, Bill. Who knows? Maybe those 30-year-olds will have moon tourism by the time they get to 55. We'll see what happens. Bill, always good to get some time with you. Thanks a lot.
Thanks for having me.
Coming up, we'll bring you today's top analyst calls on Wall Street and a look at Open Door shares as the company announces more C-suite changes. Don't go anywhere.
Welcome back to Yahoo Finance. I'm Brick DePalma. We're live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Intel, FedEx, and Tesla. First up, we have Intel. That stock is under a bit of pressure after Citigroup downgraded the stock to sell from neutral. You can see it's down more than 1% this morning, pointing to the company's, quote, rich valuation. Now, keep in mind, the stock had rallied 23% on Thursday after NVIDIA agreed to invest $5 billion in the company. Now, the analysts there are saying that the stock is pricing in success in its leading-edge foundry business, which he believes has minimal chance to succeed. Once again, that stock under a bit of pressure this morning. Plus, FedEx, that stock moving higher this morning after getting price target boosts following its quarterly report. Now, the report, which beat on both the top and bottom line, also pointed to revenue growth of 4% to 6% for the fiscal year. And that really eased some of Wall Street's concerns they had going into the quarterly report. We did hear from JP Morgan and Bank of America, both of which increased their price targets following that report. And on the flip side, its competitor UPS, well, that stock got a downgrade from BMO Capital Markets. It's under a bit of pressure this morning. That analyst citing recovery demand remains elusive for UPS, particularly within its business-to-business segment. And last up, Tesla. Shares of Tesla are climbing this morning after Baird upgraded the stock to outperform from neutral. The analyst there said the company is increasingly viewed as a leader in physical AI, of course, artificial intelligence. He also said that Elon Musk's recently proposed pay package is built on lofty targets for both product rollout and market cap. The stock now is slightly above where it was on January 1st and up about 6% year to date with today's momentum. You can see there more than 2%. Keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Opendoor, Instacart, and Alphabet. First up, Opendoor, the real estate company announcing the departure of its CFO. The move comes just days after the company appointed a new CEO, and as its founders return to the board. Opendoor has appointed Christy Schwartz to fill the role as interim CFO. She previously served as the interim chief financial officer from December 2022 to November 2024. The C-suite changes come amid renewed interest in the company following hedge fund manager Eric Jackson's bull case. Retail investors have since also shown some interest. Next up, Instacart. Shares falling on reports that Amazon has partnered with southeastern supermarket chain Winn-Dixie for grocery delivery in Florida. Wedbush analyst Scott Devitt, who has an outperform rating on Amazon and an underperform on Instacart, writes that the Winn-Dixie tie-up is a, quote, incremental step forward in Amazon's broader strategy to capture share in the category. Instacart and traditional grocer shares took a hit last month after Amazon rolled out same-day grocery delivery in 2,300 U.S. cities. And finally, Alphabet. The Google parent will meet the European Union's deadline to propose changes to its advertising technology business. That's according to Bloomberg. Google was fined $3.5 billion earlier this month by the EU over what it views as dominance in that ad tech business. Google had previously considered selling parts of the business to resolve antitrust concerns, but those were, at the time, not deemed to have met the bar required by regulators. This month's penalty pushed the U.S. tech giant's EU antitrust bill close to 10 billion euros over the past decade. The company has vowed to appeal it. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, travel companies are gearing up for a busy holiday season after a resilient summer, but some shifts appear to be taking shape. Yahoo Finance executive editor Brian Sazzi spoke to Expedia Group CEO on the latest travel trends.
Aaron, good to see you. I can't believe it's been a year. You just passed your, 1 year mark?
Yes, it's great to be back.
As CEO. So look, we're all trying to get a read onto the economy. We just had the Fed meeting this week. They cut rates. Consumer spending seems to be strong. What are you seeing from the travel perspective?
Well, certainly it's been a year sort of ups and downs. And if you looked at the second quarter in the U.S., there was softness in the market. We continue to see that the high end of the market, there's a lot of resilience. So higher income, higher spenders are continuing to spend. More softness at the lower end. But if you look at the numbers of people going through airports in the U.S. over the summer in July and August, they're up year over year, unlike the way they were in the second quarter. So people still want to travel.
Are the low income consumers, are they coming back? Are you getting a sense that is beyond the worst?
Look, it's you can't sort of make a trend out of just a couple of months, but as I said, you see more people in the airports, and that is a sign that, look, people are continuing to spend, and we'll see how the holiday season ahead of us shapes up.
Are you seeing a big difference between the international and the U.S. consumer?
So certainly for our business in the second quarter, the growth outside of the U.S. was quite a bit faster than the growth in the U.S. At the same time, we're seeing fewer international visitors coming into the U.S. this year than we did in previous years. So it's really, you have to look at each country individually, and then for us at Expedia Group, we then make our investment decisions based on where the opportunities that we see.
Why do you think you're seeing that disparity with international travelers?
Look, again, I think it depends on each local economy. The international into the U.S., I think some people have chosen to go to other destinations or to stay within their own country. Again, if I look back 5 years when we had COVID, all the travel patterns around the world changed, and they change back just as quickly. So we'll see.
What is your sense of the holiday season? Are forward bookings still a thing? Is it like that's still the measurement in your industry?
Forward bookings are still a thing, but I would say this year there have been shorter booking windows, and so again, we'll see. Are they shorter going into the holidays? Do they lengthen or not? One trend that we definitely see is that events are driving tourism. So to the extent that there are big events in the fall, certainly next year with the World Cup coming, we know that that's going to drive a lot of demand here in the U.S. We, as I said, we see the events-driven tourism driving a lot of growth.
Every time I talk to you, I'm reminded that I need to take a vacation.
I'll come back more often.
I need to. It needs to happen. I want to leave a good chunk of this conversation because a year ago you were still settling in, but I want to talk a little bit more about AI. Yep. How is this transforming, a year in, how is it transforming what you do at Expedia?
So I'd just start by saying AI is an incredible opportunity for us. And when I think of our company, that's actually celebrating 30 years next year. We had the first wave, which was about moving online with the browser. The second wave, which was about mobile and making that experience on a smaller device. And I think of AI really as the third wave. So we have to think about how do we make our products help travelers more easily find their perfect trip and take their perfect trip. How can we be more predictive? How can we be more proactive? And how can we be more personalized for travelers? Making sure that they trust that when they come to our brands or to our partners, that they're going to find their perfect trip. And then if something goes wrong, there'll be a human there that they can call to take care of it.
So you're not getting rid of the humans?
Not getting rid of the humans. I tell the teams it's AI with the human touch. There's a piece that's about what are we doing in the products for our travelers and our partners. There's also looking at how our consumer behavior is changing in where they're getting their inspiration, right? With ChatGPT, with Google and their AI summaries, people are searching in a different way. And for us, there's a lot of our traffic that comes from those places. How do we make sure our brands are showing up well there? And then, of course, there's also AI internally with our teams. And it's incredible to see the way teams across the company are using AI to give themselves superpowers, whether it's the commercial teams using AI to coach them to increase their win rate, obviously the dev teams, the tech teams using it to write code, the product teams doing easier prototypes, the marketing team. I could basically go down every function in the organization, and it's just really incredible to see the excitement and the innovation that's coming there.
You mentioned AI summaries. We see it in the news industry, how that is these summaries from a ChatGPT, a Google, and it's fundamentally changing how stuff is consumed. How has it changed the travel industry from your perspective?
Well, again, if you look at whether it's ChatGPT or Google or even on our brands, the way we can create itineraries in a much easier and more seamless way, the way that you can actually plan a trip just by chatting, it's still, though, a small portion of not only the traffic that we get to our brands, but it's also a small portion of how people are interacting with the apps. I think the more interesting thing is in the usual flow that people have for planning their trips, how can you inject AI at crucial moments? So for example, 70% of people look at a hotel review before selecting their hotel. And we're using AI to do smart reviews and summaries so that they can query it, so they can more easily find out what did other travelers say about this hotel, so they can be more confident in the choice they're making.
I do think, your stock's up 20% year to date. Very, very, very good. Very nice. But I think part of that is also what you are doing to pivot the company on AI. As you look out to next year, what is the one big AI project that investors should be excited about for Expedia?
I'm not going to answer the one project because I think that would be a bit, I'm just going to say it would be myopic. There are so many possible ways to use AI to grow the business, both to grow the business and to expand margins, that I have the team looking really across the board. By the way, I think the other thing in our company is exciting to see is we've got both a big consumer business and a big B2B business. And over the last year, we've been able to maintain the momentum on the B2B business. It's growing in the high teens, so growing quite quickly, and done a lot of foundational work in the consumer business to really make sure that each of our brands has a great value proposition. It comes through in the product. We're tuning the loyalty program, and we see the numbers internationally really showing up. So I feel good about that.
I'm asking all CEOs this, and since you're here, I'm not singling out what President Trump has put forward in terms of quarterly earnings. I asked Okta CEO about this, Todd McKinnon. He said, I'm okay, maybe if I don't have to report every quarter. Would it be good if you reported semi-annually?
Either way, what I would say is, even for us, the quarterly earnings, yes, it's an external process, and we share our results. I don't think it would necessarily change the decisions that we're making internally. We are running this company for the long term to create great shareholder value, and I think we're getting support to do that.
Do you really like answering margin questions every quarter from Wall Street?
If I can come see you every quarter.
All right, fair enough. Well, don't be a stranger. Come back in less than a year. Ariane Gorin, good to see you. Good to see all the work you're doing there.
Great to be here. Thank you.
The
Fed delivered its first rate cut of 2025, lowering interest rates by 25 basis points and seeing more cuts coming for the rest of this year. Chair Powell framing the move as a risk management cut, underscoring that while inflation remains elevated, job gains have slowed. Here to come through what comes next and what it means for your personal finances. Let's get to Concurrent Wealth Management founder and wealth advisor, Preston Cherry. Preston, it's good to see you. So the Fed cuts, Preston, and I'm sure some viewers are thinking, when am I, as a consumer, going to see the impact of that? What do you tell them, Preston?
Well, I'm telling them that the business of borrowing is still expensive, but the business of investing is spot on. I mean, right now, the portfolios are doing well. However, the pocketbooks are being stretched a little bit. I mean, we're in a bull run as far as the market is concerned, but the economy is like a bunny. It's just bouncing along a little bit. I mean, it's kind of lukewarm. As you mentioned, jobs are tepid at best, and inflation is still a little elevated at 2.9%, almost 3%, almost a full point over where the Fed wants it at 2%.
How long does it take, Preston, for a Fed cut to trickle into the financial products a lot of us depend on, mortgage or credit card loan?
Well, it's important for folks to know that the Fed can only signal interest rates, and the market really sets interest rates like mortgage, demand for example. And right now, mortgage rates have been trickling down a little bit. I mean, right now, mortgage rates are at 6.35, something to this effect, and its supply is starting to loosen up a little bit. But at any given time, with tariffs, that could choke supply again. I mean, it's really sensitive right now in the housing market where anything could set interest rates back up. That said, the bond market is more of a telltale sign of how interest rates are going to be in markets like HELOCs, mortgage, and the like. But as long as the Fed is signaling loosening the interest rates and signaling future economic, conditions, then those rates, like I mentioned, HELOCs, mortgages, and credit cards and the like, then borrowing could not elevate as much and stay in a range that people can manage.
Preston, what about those folks listening right now? They're focused on savings, retirement. How do rates play into it for them?
Well, again, rates are good, or markets are good right now for those that are talking about retirement, because if people can stay committed and separate Wall Street from Main Street and then your street, those are three different streets. Wall Street right now for portfolios are doing great. So if you can stay committed to a consistent investment plan, then you can take advantage of those compounding returns at any life stage that you're in. If you're young, then you have a lot of time. Gen Xers, for those that I serve, then you have to increase that savings rate because retirement is right around the corner, and a lot of Gen Xers feel behind. Main Street, it's the economy, and refrigerators and big ticket items. That's where those prices where you can feel the big pinch. And then your street, those are budgets, those are career choices, because right now jobs are not being added that much, and then when jobs are being displaced at companies, particularly those jobs that are high income, companies are not replacing those. So again, that's a sign for companies that are saving at the balance sheet, which is increasing companies' portfolios, but not very good at the household level, meaning your street.
Preston, speaking of your street, I mean, for those who want to invest broadly, Preston, what are you advising in terms of crafting a portfolio against this backdrop in this environment? Well,
I know people don't like this, but you got to stay diversified. Boring is the still sexy, right? Meaning stay diversified across portfolio, so you won't get jammed up into one or two stocks. That said, you can also take advantage of volatility that may come. Those headwinds to where headlines that may come, or news, that's short-term volatility, or economic unrest that are uncertainty that may come. Remember, I said that this is a bunny economy just hopping along here, and any type of uncertainty that comes, that you may have a shock to the market, and you have that opportunistic investing, then those are the times where you have cash on the sidelines to where you're not panic selling or panic buying, but you do have those pre-planned pockets of money to where outside of your core portfolio, you're saying, okay, let's take advantage of these opportunities.
Yep. Preston, thank you for your time today, sir. Appreciate it.
All right, thank you.
In the past year, Bitcoin has risen by over 80%. It's currently above 116,000, just below that level, following a recent pop after Wednesday's Fed rate cuts. But according to a 2024 study from the Federal Reserve, in 2023, just 7% of Americans had used cryptocurrency at all. So how should the average investor be considering adding it to their portfolio? Tyrone Ross, 401 Financial Principal and Founder, is joining us for this week's FA Corner, brought to you by Capital Group, to talk about just that. Good to see you. Thanks for being here.
Thank you for having me. Excited for this chat.
Yeah, I think for a while there was talk that people should have kind of 2 to 3% maybe in their portfolio in crypto.
Yeah.
What are you telling clients, and are you getting a lot of questions about this?
Always getting a lot of questions. It's funny, the questions now are mainly from financial advisors, right? Of what that number looks like. And I feel like anywhere from 1 to 3%, you don't really have that much conviction, right? So you add 1% to the portfolio, you get 99% of the headaches, right? So I think it's somewhere in that 3 to 10% range, depending on the client, risk tolerance, age. But I am getting a lot of questions more from advisors because clients are asking advisors more, what does that allocation look like? So I'd say 3%. There's been a lot of studies around that range, and I think it gives advisors a good framework to allocate on behalf of clients.
Well, and when you're talking about allocation, I mean, if people have been in stocks, and particularly large cap tech stocks in the past few years, they've done fine, more than fine.
Yep.
So kind of what role does crypto play in the portfolio when you already have good returns on the equity side, for example?
I think you make a good point there, and this is what I tell people all the time. If you've done well, you have ample liquidity, you hit all your savings goals, things are right, you don't need crypto or Bitcoin, right? And I think also that's where you start to make the decision. If you want to get access to this at all, you should start with Bitcoin, a small allocation there to get used to what it's like. When you get into crypto and altcoins and all that other stuff, you should be a little bit more tech savvy. You should understand the space, but I think stay home with Bitcoin. But a lot of that has a lot to do with where you are, right? I think younger clients obviously have owned it. They will continue to own it. Advisors need to adjust to that. But if you're older and you've hit all your goals, you sent the kids to college, you got the home you want, you really don't need this. And if you are going to allocate it, there has to be a really good reason why, and I haven't really heard many yet.
I mean, I think certainly in early COVID, when people were getting stimulus checks and there was this sort of that resurgence in interest, it felt like people were viewing it as a lottery ticket.
Yes.
In some ways. So I'm sure you have some FAs come or some clients come and say, isn't this my path to riches?
Yeah.
Right? So how do you manage that, or what do you tell them?
Yeah, I could tell you about a real actual case. So at my firm, we onboard a lot of young folks that have made multi-millions in this. So it was essentially a lottery ticket that hit. But I think those that are trying to catch up and they see the price action and say, okay, well, I'm going to take $10,000, and they immediately put it in, and that 10,000 goes to 3. They sell. I hate crypto. Right? I hate Bitcoin, right? So I think having a strategy, knowing what you're going to do, and then I tell people all the time, if you don't have at least a 5-year time horizon, leave this stuff alone, right? And start small. The example I use is look at a local restaurant for your family to go there and eat, get the best of everything. What does that cost? Put that amount in, leave it alone, right? If it goes to 0, you'll still be able to keep the lights on, pay the mortgage. If not, if it doubles, you're not going to be able to take, a trip to the Swiss Alps or something. You're good, right? So start small, start to understand it. And I think that's what most people need to do. It's still early, but a lot of learning and education needs to happen.
And what do you think is the best way for people if they're getting in on that level? Do they buy Bitcoin itself? Do they buy the ETFs? Do they buy a broader ETF that holds more of the different types of currencies?
Really good question. Again, I think that's a case-by-case thing, but I've always told people, so I've been in the space since 2014, it begins and ends with Bitcoin for me. Buy a little Bitcoin, start to understand it, see how easy it is to buy, easy it is to sell, and just watch how it moves and behaves, and I think you'll learn a lot from that. And then I think as you start to graduate, you can get into some of the other coins. Now, as far as an ETF, I think that's the best way for most people right now. It's at your Fidelity, Schwab, your brokers. It's in a wrapper that is compliant and approved. So I think that's the best way. Not my favorite way, but it is, I think,
your
for most
favorite way
people.
would be to buy Bitcoin.
Buy it directly.
Interesting.
Yeah, I don't think you put training wheels on a Ferrari.
And then what about this new wave of treasury companies? All these companies putting Bitcoin and other crypto on their balance sheets. Is that sort of a step up or like a level of complexity that you think most people are not ready for?
They're not ready for how the DATs, right, digital asset treasury companies, are conceived and brought together, but I think they are ready for the fact that it trades on NASDAQ, right? So this is the first time in my career where clients can get exposure multiple ways. You can own it directly. You can have it in an ETF. You can do it through a DAT. You can hold a strategy or a Coinbase or a Tesla. There's a lot of ways to get access here. So I think as far as the DATs are concerned, you got Solana, you got Ethereum, you got Bitcoin. Again, they're public companies, but again, I think there's a long explanation there to get people to understand this. Keep it simple, buy the ETF for now, and then, go on to live your life.
I like it.
Yeah.
Especially the go on and live your life stuff.
Yeah.
Well, Tyrone, thank you so much. Good to see you.
Absolutely. Thank you for having me.
Thanks for joining. Today's FA Corner brought to you by Capital Group. Coming up, full market coverage ahead in the second hour of Market Catalyst. We'll be talking more crypto, Solana specifically, in just a moment. Don't go anywhere. Coming up this hour on Market Catalyst. First up, U.S. stocks extending record gains. We'll have full market coverage ahead and a look at how digital assets are performing as well. Plus, we'll go live to the NASDAQ to speak with the CEO of e-commerce firm Pattern as the company makes its public debut. And we'll bring you everything we know on the call between President Trump and Chinese President Xi Jinping. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Remember, any gain today for the major averages will be another record close for them. The NASDAQ's been leading gains today as we see large caps tech rally here. The NASDAQ up 0.4%. That's double the gain in the S&P today, which is in turn about double the gain in the Dow, which is up 52 points on the session. Well, despite a pullback today, cryptocurrencies and crypto-related stocks have had a bull run, notching record highs and receiving increasing institutional adoption over the past year. And according to a new study from the DeFi Education Foundation, a growing share of Americans are interested in exploring crypto, with 22% saying they would like to learn more about the blockchain and crypto more broadly. Here with more on the landscape for crypto is Kristen Smith, president of the Solana Institute. Kristen, good to see you.
Good morning, Julie. Nice to see you as well.
So what kind of sort of changing views did you see in this survey work that really stood out to you?
Yeah, well, I think the big takeaway for me from this study is that Americans are increasingly frustrated and concerned about the financial services industry. We have less than half of Americans, 49%, who believe that the financial system meets their needs. That's pretty low in my mind, but shockingly, less than 1 in 10 Americans completely trust the bank. So these are pretty low numbers for the banks. And I think one of the things that crypto and DeFi in particular have to offer is an alternative or even potentially an improvement to the current system, because they're able to hold their own assets, then they can trade, borrow, and lend using those assets. And so I was really excited to see the opportunity that we have for the crypto industry to either completely replace or perhaps converge with traditional finance to make this a more trustworthy system for everyone.
Well, I'm curious, Kristen, when people say they're not happy with their banks, what are they not happy about, right? And does crypto solve for those things that they're not happy about?
Yeah, well, a lot of what we see are fees that are misunderstood, perhaps are disclosed, but there's so many disclosures that they don't know what they're getting into. And if you look at DeFi, the cost is a lot lower. And then they also feel frustrated about access to certain products. And so, with DeFi, it's different. And again, this isn't a world that's for everyone. But I think what's really exciting is that whether it be through stablecoins for payments or on the market side, upgrading the infrastructure that we use for trading markets, there's a real opportunity here. And what we do at Solana Policy Institute is we focus on a lot of the policy work going on in Washington. And as Congress is passing laws and putting new regulations in place, it really provides a foundation for this technology to be integrated within these systems so that we can lower costs and provide consumers more access to better services.
Well, and I guess on that point as well, I mean, certainly some of the large financial institutions are looking at DeFi and looking at blockchain as well and integrating that in some cases into their businesses. So what do you think the landscape going forward is going to look like in terms of the services being offered and who's offering them?
Yeah, well, I think we're going to see a lot of innovation across the board. I think one really interesting idea, and this is something that actually the chairman of the SEC, Chairman Atkins, has focused on, is this sort of concept of a super app where you can have your crypto portfolio, your securities portfolio, your stable coins, your mortgage. You can have all of your financial assets in one place. And so if you need a short-term loan and you don't want to, you have some Apple stock, you can leverage that Apple stock to get that loan in DeFi without having to, sell that underlying asset. And so there's a lot that you can do with collateral in DeFi across different types of assets that is not available to consumers today. And so we think, these are the types of innovations that we're going to see. But, I think the key is it's a very American principle to want to own your own property. And, when you're dealing with the banks today, you're really handing over your assets and then it enters the fractional reserve banking system. This provides an alternative for that percentage of the population that does want to have more control and to be able to interact directly with counterparties, whether it be in payments or trading or borrowing.
I mean, I think the trade-off for that traditionally has been safety and security, right? And being at an FDIC insured institution, for example. So what is sort of DeFi's answer to that?
Yeah, well, I think the DeFi's answer is you have 100% of all of your assets, right? I think the reason we need FDIC insurance is because if something goes wrong, there aren't enough assets to return to those customers. And so, this is a way where a customer can choose to keep control of their entire set of assets. But, I do think that, as we look across the spectrum, and I actually thought Tyrone prior to this was very interesting in that holding crypto is not for everyone. It's for some people. It's not for everyone. I think what's also interesting is as people are looking at crypto as an investment opportunity, we are seeing the emergence of these digital asset treasury companies and ETFs that we are expecting to hit in the next week or two. So we're now seeing more opportunities for not just having an individual have an alternative to their investment system, but now we're seeing crypto enter the traditional regulated system as well. So we're seeing a lot of mixing and converging in these two spaces. And I think as we get more and more regulatory clarity in the months ahead, that we're going to continue to see the kind of cross-pollination between these two worlds.
One of the other study results that stood out to me is a lot of people don't know what decentralized finance even is, right? There's it looks like extreme familiarity with crypto. Not bad. It's at 16% if you look at how many are familiar with the asset and how many are likely to use it in the future. For decentralized finance, it looks like only about 3% of your survey respondents are extremely familiar with it. So you got a long way to go.
Yes, there's a long way to go, but I think, the key for this adoption of this technology is not for people to be able to understand how DeFi works. It's for them to be able to go to a familiar place that's easy to use and get services they do understand, like the ability to borrow, the ability to lend, the ability to trade. These are all things that are familiar to people. And if you could simultaneously within maybe your brokerage account also be able to interact with DeFi without even knowing you're using it, I think that's how we'll really have succeeded. I mean, I think about the internet. Most consumers don't understand how the back end of the internet works. They just know they can go and see the content they like or post a picture or communicate with a friend. I think when we start seeing people just actually using the services, the technology is going to lie underneath and behind it. And I think that's how we're really going to get the mainstream adoption of crypto and DeFi technology.
Kristen, good to see you. Thanks for joining us.
Yeah, great to be here, Julie. Julie, thanks for having me.
Much more markets action coming up. You're watching Market Catalysts. There's some headlines trickling out from President Donald Trump's call with Chinese President Xi Jinping. This coming from the Chinese official state news agency. And according to that report, Xi is saying the U.S. should avoid restrictive trade measures. That's what he, according to that report, told President Trump in their call earlier today. Also, with regard to TikTok, Xi reportedly said the Chinese government respects the wishes of companies with regard to negotiations over the outcome of TikTok's ownership in the U.S. TikTok owned by ByteDance of China now. So we are awaiting any kind of commentary from Trump himself. We're expecting him to post some commentary and to tell us what his perspective on the call was shortly. So we will be awaiting that and awaiting any other clarity on what came out of this phone call today. Not seeing any kind of reaction in stocks to these headlines. Well, e-commerce firm Pattern Group going public on the NASDAQ today, set to trade under the ticker PTRN. I want to toss it over to Yahoo Finance senior reporter Brooke DePalma, who is speaking to Pattern co-founder and CEO David Wright. Brooke?
Good morning, Julie. That's right. I'm sitting here with Dave Wright. Dave, congratulations on the IPO
Thanks
today.
So much. Thanks
what
so
a big moment. Now you did start this company over 12 years ago. I believe it was over lunch with your co-founder Mel that you began chatting about this moment right here. We've seen such a streak of IPOs lately and the success of them. Were you just trying to strike while the iron's hot right now?
Well, we've been planning it for quite a while. The core driver for us on the IPO front is, we have, if you look at the balance sheet, we have $215 million in cash, no debt. So we don't need the money, but what we couldn't do, we couldn't compete with the Googles, the Amazons of the world on AI and tech talent, which is core to our, is what we're built on. So we needed to take fake money and turn it into real money for the team.
Now, you say that you've been doing AI for a long time. It feels like that's all we've been talking about lately, though. What has this recent momentum, especially with all those other companies now, Amazon, Google, all really touting about it? What has been the momentum lately for you since you've already been doing it, it seems?
Yeah, I think that's been, in the machine learning, natural language processing world, the folks have been doing that for years, like our team. I mean, we had patents that were AI patents before anyone ever even talked about it. And so it has been fun. It's really the transformer model that has changed the game. And it is game changing for e-commerce. If you think about it, it's very content centric, text-based, content. And the impact that you can have in a consumer journey world with good content or slightly better than content than a competitor. Because what we do for brands is we help brands grow across marketplaces around the world using a technology and AI stack that has, we've invested $142 million in it. We have 400 people working on that. And but it's a global problem to solve.
I do quickly want to hit on that because when you think about consumer behavior, what we saw, especially in the August retail sales, was non-store, so e-commerce platforms see a growth of about 10% in the month of August alone. But consumer behavior seems very hard to navigate right now, especially with all the noise of sponsorships. You also have this algorithm that brands are trying to beat. So how do you guys play a role in that?
Well, the core of the technology stack, the way we calculate revenue is just a formula, right? So revenue for a brand is traffic, eyeballs to a product or listing. Conversion, can you convert it? At what price? And is the product available close enough to the consumer? And then you want to be in a place where you're chosen. Consumers have a lot of choice today, and we want our brand's products to be first on their list.
Now, one of the platform's initiatives as well is really accelerating brands on a global platform. You guys are a global company, specifically within the China marketplace. How exactly are you navigating the current landscape that we're seeing right now with your clients?
Well, I mean, they've been so far. We've had great success in China. We have about 200 people there. We continue to build the platform, and for us, they've been very friendly. Great relationships, and we've been very successful there.
With the de minimis policy ending, has that impacted any of your clients, and how are you navigating that?
It hasn't impacted us much. That's more importing. When we take goods from a brand, generally it's millions of dollars. not smaller amounts. So we haven't really had an impact with the de minimis.
I do want to take a step back because consumer behavior right now seems really hard to navigate. I see people that I've spoken to, like a PwC expert, Ali Furman, says the consumer really has to be convinced to buy right now. They're really seeking out value. How are you working with your clients to find the right price point that will really succeed in getting clients to buy the merchandise?
Well, for us, it's just all mathematical. So we don't know exactly how to drive home the great branding. I mean, that's what our brands do, and they build great products. But if you have a great product, you will have mathematical propensity to win in a marketplace. And that's what we do. So we actually, the formula works much better with a great product that really resonates with the consumer, because you have a much higher mathematical propensity to win over a consumer.
Yeah. Really quickly, in the next 5 years, what are you looking forward to most, especially with this run-up of AI and this momentum that we're just gaining now?
Oh, we have a couple things on our list. One of them is that's sort of just fun to talk about. It's a good rallying cry. Is we have in Utah there hasn't been a Fortune 500 company in like 30 plus years, I believe, is the number. And of course Idaho has a couple, and Arizona has like 8, and Texas. So we're wondering, we want to put Utah on that list, and I think we're on path to do it. So that's a fun rallying cry for the next few years.
All right, Dave Wright, we'll look out for that. Dave Wright, CEO of Pattern Group, thank you so much. I appreciate your time and look forward to continuing such a conversation soon.
Thanks for your time.
Back to you guys in the studio.
Thanks so much, Brooke. Appreciate it. We'll be right back with much more Market Catalysts. Stocks are at record highs after the Fed's first rate cut of the year, with Chair Jay Powell calling it a risk management move to cushion a cooling labor market. But with valuations now nearing levels we haven't seen since the late 1990s, the question is whether this run is justified or if we're drifting into bubble territory. For more on what strategists are saying, let's bring in Yahoo Finance's Ali Cannell. Hi, Ali.
Hi, Julie. And yes, historically, Fed easing at market peaks have often led to more gains, but now valuations are pushing towards those higher levels. And Wall Street is divided over whether this rally is very sustainable moving forward. Some strategists argue AI-driven earnings growth justifies today's multiples. Others warn that Fed cuts could spark a dangerous melt-up, while some skeptics see bubble risks building as inflation lingers. Here's what they told us this week.
I think it can be justified, and if you look at the earnings prospects for these companies, you're talking, earnings expectations that have come up.
It's just amazing to see. The market pretty much has selective hearing right now, and all it's hearing is Fed cuts, which are great news for risk assets. It almost feels like bad news is good news and good news is good news, because all of it means that the Fed here is going to continue cutting. The S&P 500 right now is trading at 22.5 times forward earnings. The most expensive they've ever been in the late 90s was 24 times. So we're certainly getting up there.
We're in the camp that thinks that inflation will be stubborn, and therefore we expect at some point in time this incredible mania, this bubble that has now been exacerbated by the race for AI. When it breaks, there's going to be a lot of heartbreak because the S&P 500 is completely twisted up in the game.
Now, Wall Street strategists have been hiking their price targets across the board, citing Fed easing along with AI. They did warn that some volatility is warranted in the interim, so we'll see where stocks can end up. But in the meantime, those bubble risks, they are starting to become more of the conversation.
Thanks. Now time for some of today's trending tickers. We are watching Paramount, Skydance, UPS, and Apple. First up, Paramount, Skydance. New reports from CNBC say the newly formed media company could make a bid for Warner Brothers at $22 to $24 a share. Paramount is considering a purchase of Warner Brothers, which is a market cap more than double the size of the company, with financial support from the Ellison family. That's according to various media reports. The reports of a potential bid came last week and sent shares of Warner Brothers soaring, but any potential deal faces hurdles as Senator Elizabeth Warren has threatened to block any merger. Next up, UPS. It's downgraded to market perform from outperform at BMO Capital Markets, which sees, quote, persisting macro challenges for the package shipping company. The analyst says macro challenges have been further heightened by shifting U.S. trade policies, including the ending of de minimis exemptions. The company cut its price target to $96 from $125. UPS now has 15 buys, 16 holds, and 3 sells. And finally, Apple. The company's new slate of iPhones officially going on sale today. It's the first time since 2020 that Apple's rolled out several new iPhone designs. Among the new handsets, it also released into stores the Apple Watch SE, Watch Series 11, Watch Ultra 3, and AirPods Pro 3. The new phones, which bring a fresh look in addition to battery life and camera improvements, attracted long lines at Apple stores from Hong Kong to London to New York to Los Angeles. At the Fifth Avenue location in Manhattan, a line for walk-ins, people who had not pre-ordered a device to pick up, wrapped around the block. Those shares up nearly 2%. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the S&P 500 quarterly rebalance going into effect. That means new stocks for the benchmark index. At the start of trading on September 22nd, 3 new names will enter the index: Robinhood, AppLovin, and MCore. Well, Robinhood and AppLovin are well known to retail investors. MCore, not exactly a household name. So what exactly does the company do? It's based in Connecticut, and it's one of the largest specialty contractors in the U.S. and a leading provider of electrical and mechanical construction and facilities services, building services, and industrial services. The company's origins go all the way back to the 1800s, when it supplied water to some residents of Queens and Nassau counties in New York. After a century of mergers and acquisitions, it took the name MCore in 1994, and in 2000, the company officially began trading on the New York Stock Exchange. It now has a market cap of nearly $28 billion and more than 40,000 employees. Inclusion in the index can elevate a company's profile and boost demand for its shares from passive investment funds that track the index. Companies must have a market cap of at least $22.7 billion and meet profitability, liquidity, and share float standards to qualify for the S&P 500. Coming up, how to play REITs. That's next on Market Catalyst. Real estate investment trusts, also known as REITs, are in focus, with the Fed cutting interest rates by a quarter point at September's FOMC meeting. Yahoo Finance's Josh Lipton spoke to Handel St. Just, a senior REIT and homebuilders analyst at Mizuho Americas, about how to play the sector.
You figure, Handel, the Fed cuts, that's good news for REITs. Is it good news across the board, or no, you gotta pick your spots, particularly in the apartments and storage names that you know so very well?
Hey there. Well, thanks for having me. And yes, it's been an interesting year for REITs in the aftermath of Liberation Day, tariffs, slowing macro, and now rate cuts. So the REITs are up 4 or 5% a year, but they're still lagging the S&P by about 1,000 basis points. But we've seen a good amount of dispersion within REITs, with a longer duration, more defensive sectors like triple net and healthcare leading the way, while apartments, storage, and retail have lagged. And so, our work has shown that rate cuts can be good for REITs broadly, but there is, some distinction between the different subsectors on how they perform. And so, as you alluded to, yes, we think that, investors need to be a bit selective. We think long duration, triple net, spread investing subsectors that are more defensive will likely continue to be relative winners. We've seen the apartments and storage lag. There's been some concern about demand and a slowing macro, the consumer pricing power. And so I think you have to be a bit more selective among some of those subsectors.
So you got to stay selective, stay smart, do your homework. In apartments and storage, I am curious, Handel, where do you see opportunity?
Absolutely. So I think broadly, look, I think in apartments, we're in the shoulder months where demand is weak. It's been a bit of a challenging year for apartment landlords. They haven't achieve the pricing power that they wanted. So on top of, the macro being a bit choppy, there's concerns about pricing power. But, here we are going into the slower time of year and all eyes are on 26. And I think there's a couple names, Mid-America, MAA, Camden Property CPT, which are trading cheaper than peers and which importantly have an inflection in their growth profiles into next year. And that's important because historically that inflection, that improving second derivative, tends to be a very positive indicator for future performance. So we like the setup. Supply is falling, pricing power should be improving in the aftermath of that supply falling, and more importantly, the core growth prospects are improving into next year and should accelerate into 27.
When we talk apartments, Handel, are there important regional differences and distinctions you would highlight?
Absolutely. So I think it's, certainly the national apartment market, tends to be viewed as one big behemoth, but, we're looking at regions and looking at cities, and, we see a recovery opportunity, and that recovery is important because, obviously the future growth potential, it suggests, and the Sun Belt is a region that's been overburdened with supply the last couple of years. That supply is coming down dramatically into next year. And there's a window here in 26 through 28 where there'll be below average supply. So we like to set up there over the next couple of years. But you got to be a bit more wary of the coastal markets. They've been really strong the last couple of years. The comps are tough. New York City is a strong apartment market, should be fine the next couple of years with low supply. But DC, you're concerned about Fed job cuts and Doge. Los Angeles showing some weakness broadly within that region. Boston is slowing a bit. So a few more of these coastal markets are slowing, but the best market in the country today is San Francisco. And as a result, we like a company named Essex Property Trust, ESS, which has about 40% of their cash flow exposure from San Francisco.
Handel, let's say mortgage rates keep dropping and homes get more affordable. 30-year fix, I'm just looking here. Mortgage News Daily, 637. Let's say that kept dropping, Handel. What would that mean for the apartment subsector?
Absolutely. So I think that's a great question, certainly one that we're getting from investors these days. And, one of the tailwinds for the apartment space the last couple of years for demand has been the unaffordability of housing. On average, it's about 50% more expensive nationally to own versus rent in some of the coastal markets like San Francisco, New York. It may be even 2x. So with rates coming in, that has helped. The 30-year mortgage rate's gone from near 7 to close to 6.4. Rate cuts in the near term probably benefit more the shorter end of the curve. Inflation's sticky. I'm not sure the long end comes in really over the next few weeks, few months here. So something we're watching. But I think that rates today at 6.4 still a bit higher than where we think the sweet spot for a real increase in demand for home buying could be, and that could be closer to the 5 to 5.5% range. So think another 100 basis points of decline from here, which doesn't appear likely, but also think about what would need to happen for rates to decline that much more. Of a weak economy, consumer confidence would be low. So we're not even sure that if rates were to continue falling on the long end, that there would truly be a real shift in consumer demand for housing, because consumer confidence matters. And I'm not sure in that type of backdrop that I just described that there would be a strong amount of consumer confidence and demand for the for sale side of the housing market.
Is there, and I think you sort of hinted this before, is there a seasonality to that apartment subsector?
Absolutely. So think about when the weather's warmer, your kids are out of school. It's just an easier time for people to look in the spring and into the summer. So the time of year that apartments tend to work best tend to be from, call it March through June, July. And here we are in September heading into October. Landlords tend to play more defense. So it's a better time of year to be shopping. You have more negotiability on your in terms of some of the rates that you can get for apartments because there's less people looking. But the landlords are also savvy in that they also gear less of their expirations during these slower shoulder months. So, I think that there's a little bit of operational acumen on their part to make sure that there's not too much availability during these times of year. But yes, this time of year, rent tend to fall a little bit. There's less demand and landlords tend to play a bit more defense. So if you're looking for an apartment, you're better off getting a better deal in the fall and winter months.
And now finally, we've been talking apartments here. What about shopping centers? That's another sector I know you know very well. Any picks there, Handel, you would emphasize? Consumer does seem to be hanging in there just based on the retail sales data we got this week.
Absolutely. So I think there's, it's a sector that, people tend to worry in a slowing macro. Obviously, there's been lots of chatter about, the consumer and their ability to spend and, just how stretched that consumer is. But there's been resilience, as you mentioned, in some of the retail sales. And shopping centers, remember, are catering to more of a defensive nature. Think grocers and more essential items. So there's more of a defensiveness to their retailer base. But also what's important is that there's really no supply. And so I think landlords have had pricing power. We see an opportunity for the stocks to continue to work near term because there's a meaningful amount of embedded growth from leases that have been signed that will start cash flowing over the next year. So you don't need a lot of external growth acquisitions to really generate that growth. So defensiveness with a steady, consistent cash flow growth profile of mid-single digits for next year, which is comparable to this year. And so we like a name Regency, REG, Brixmor, BRX, because they have the highest amount of grocer exposure. And as I mentioned before, that brings an element of defensiveness on top of the pricing power that landlords are benefiting from today.
Hendel, appreciate your time and those picks. Thank you.
President Trump touting progress following his call with Chinese President Xi Jinping, saying on Truth Social that the leaders discussed trade, fentanyl, the need to bring the war between Russia and Ukraine to an end, and the approval of the TikTok deal. He went on to say the two will meet at the APEC summit in South Korea, and then he'll go to China in the early part of next year. Joining me now to discuss, Ian Bremmer, Eurasia Group founder and president. Ian, it's always good to talk to you and get your perspective on these matters. We did notice that stocks kind of came off their highs after we started to get these headlines. I mean, you know, it's all sort of seems vaguish from these two sides. What do you think came out of this call? How productive was it?
It's a short call, and it shows that there is a desire to engage in serious negotiations, because if you're doing a summit meeting, you want to have something that you're going to be able to announce. And so no one was expecting any breakthroughs on any of this, but it's very different. I mean, you couldn't have a more different dynamic from where we were in the weeks after Liberation Day. The United States and China had essentially imposed trade boycotts on each other, and we're also looking at a significant decoupling in the near term. That is not where we are right now at all.
Well, so where are we exactly? And will the result of where we are be better than where we were pre-Liberation Day in the prior tariff regime?
I think it'll be more stable. So in that regard, it'll be more predictable. And, you know, in the pre-Liberation Day run-up, it wasn't. People were expecting that there were going to be, you know, sort of big hits that the Americans were prepared to take, or else to lots of other economies. And of course, Trump has been, you know, quite hawkish on China in his first term, as was Biden. There's now a shift. We are very close to announcing the details of what this TikTok deal is going to look like. That wouldn't happen unless there was a summit meeting where the Chinese and the Americans are exchanging levels of confidence that they are going to improve their relations. The United States recently reduced some of the expectations for a defense aid to Taiwan, making the Chinese quite happy about that. There's been a lot of talk about restrictions from China on the precursor chemicals for fentanyl export, and those chemicals are needed, so it means a much better capacity for the Chinese to know which customers they're going to and restrict other sales. If that happens, that's going to be a fairly significant piece of the tariffs that come off from the United States. So all of those things are in train. But that's very different from saying that China suddenly is going to trust the United States. No, those summit meetings you saw with the Shanghai Cooperation Organization, as well as then with Putin and Kim Jong-un, that's where China's heading. It's building an alternative where they're telling countries around the world, you can't trust the Americans, they're unreliable. You can trust us, work more with us. So clearly, long term, this is going to be about more decoupling and more fragmentation in what had been a more globalized environment.
Well, I'm curious how that message is being received, because on the flip side, we had President Trump meeting with Keir Starmer in the UK, you know, quite a greeting there in terms of pomp and circumstance. Yeah. So how much is, for lack of a better word, how much is Trump winning in this court of opinion around the globe?
He's the most powerful leader right out there, in the sense that, I mean, he can't get everything done, but he has incredible loyalty, and the U.S. is the most powerful country. But that doesn't mean people like him. The United Kingdom is legitimately very friendly in their disposition. Remember, Biden and Obama personally didn't really like the UK. Trump does. He likes the royalty. He owns the golf course. I mean, like, he really does quite like it there. And he was really looking forward to how historic this trip was and all the pomp, and as you say, so that's real. But when you talk to other leaders around the world, not many of them want to have fights with the United States, but almost none of them, have a level of trust for the U.S. and the U.S. president. And so there is a problem that the United States is no longer really thinking about the long term, that the U.S. is undermining its relations with other countries and making them want to hedge away from the U.S. long term. No conflict near term, unless you're China or a country, or Russia, a country that feels like they have the cards and can stand up to Trump and stand up to the Americans. Most countries can't stand up to the Americans, but they don't want to be in a position where they have to have this vulnerability in the future, and that bodes badly for the U.S.
Ian, as you know, the UN General Assembly set to begin Monday. World leaders will be gathering here in New York City. UN Secretary General Antonio Guterres has urged world leaders to, quote, get serious and deliver, highlighting things like peace, climate, responsible innovation, gender equality, development financing, UN reform as central themes of the week. None of those things, I think it's safe to say, are the priorities of President Trump. He will be addressing the UNGA. So given those dynamics you were just talking about, how does that play out next week? What do we need to be watching for?
Well, I spoke at length with Antonio on Monday. He's a good friend. And we were talking about these themes and the reality that the G7 is not united in their support for rule of law, multilateralism, and the UN. The BRICS are not united in coordinating policy, in creating an alternative. But if the United States and the G7 don't stand up together, that the alternative is going to be other countries will have much more influence, most notably China. And I mean, look, the Chinese have long been the last country to pay their dues in arrears, usually right along with North Korea. Just last week, they decided that they were going to pay up a couple $100 million to the UN. Why would they do that? Why would they support the UN when the Americans aren't? Precisely for that reason, because they recognize that they can make a lot more appointments to the Secretariat. They can have a lot more influence over the UN organizational structure if the Americans are going to decide that they no longer care about this institution that, of course, was originally a U.S. creation in America's image. It's a big opportunity for China. It's not just them eating America's lunch on the global stage. It's that the United States is actually catering the meal.
So, Ian, all of that said, our bread and butter here at Yahoo Finance is the markets and the economy. Markets are doing great here in the U.S. Stocks are doing great. Yeah. The economy seems to be doing just fine, which has defied a lot of the dire pronouncements about what this whole tariff battle was going to result in. And so going forward, I mean, what you're talking about, this remaking of the global order, does it seem like the U.S. can kind of be fine, even given all of that?
That's long term. You don't care about the long term. You're Yahoo Finance. You care about the short term. You care about the markets. Deficit spending is great. You're not going to have to pay for that bill, not in today's market. The U.S. is great at the short term, and we have a president that is great at the short term. So if I'm an investor in short-term markets, I don't worry about any of this.
Well, I mean, over the long term, stocks go up too, right? So is there anything longer term in the scenario you're painting that will eventually be an economic disaster?
Well, again, anyone that looks at America's trade deficit and the lack of benefits that are coming from it, long term, you're not going to be able to pay for Social Security or health care. That's a long-term hit. Again, people aren't, there are no, Rand Paul cares about this. There are no other members of Congress that care about this because it's not a near-term concern. Long-term, when you tell Brazil, the largest economy in Latin America, that you're going to hit them really hard, not because they have a trade deficit you're running, you actually have a trade surplus with them, but because they're doing something you don't like, the Supreme Court with the former president in upholding their own rule of law, they are now hedging their trade with Mercosur, together with the EU, with EFTA, with India, with China, with everybody else. Long term, that means less trade with the United States. Long term, that means cost of goods will go up. That means there'll be less efficiency. I mean, if you're telling people that they're not as welcome at Harvard or they're not as welcome as immigrants in the US, you're telling South Koreans they're not as welcome. You're telling brown people they're not as welcome, and there are a lot of very talented brown people around the world, then long term, that's going to affect the American economy and the markets. But again, the revealed preferences of the US government and its leadership, Republicans and Democrats, are that the long term don't matter. So we should just embrace this, especially on Yahoo Finance, and say, let's smoke them while you got them. I mean, that is what capitalism today is all about in the US.
Well, that's sort of depressing, isn't it, Ian?
Not if you're in the markets today, it's not.
Sure.
Of course not.
Yeah. Something finally I want to get your take on to just go in a different direction is the Jimmy Kimmel situation. And I ask you this through the lens of that you have been a student of, global geopolitics. You have seen what, for example, state-run media looks like in other places. Is that what the U.S. is going to? And I mean, again, one would think there would be implications for people who invest in the media companies, for example.
Well, the fact that there was a major merger that was going to reflect billions of dollars that the FCC was saying basically would be very sad if something were to happen to that merger. There was economic pressure placed directly by the Trump administration to remove Kimmel. And that's what they've done. And obviously, that money is more important than standing up for this guy whose ratings were not great. And, the principle of independent media is less important than the money. So, I mean, you said you were moving to something else, but actually we're talking about the same thing. I mean, you're not going to see courage from CEOs in attacking a U.S. political system that they are fully invested in, even if it doesn't necessarily align with classical liberalism, openness, freedom of speech, and free market competition. It's very clear that there are many, sort of CEOs out there that are prepared to be quiet and comfortable and not have a fight in this environment. I understand that. I mean, that is what shareholders are demanding, but it probably means that democracy is going to get a lot weaker. If Trump's intention is to undermine opposition speech, if he wants to weaken the left, if he wants to weaken media that criticizes him, and there are many examples of leaders that have done that, Erdogan in Turkey, Orban in Hungary, not just dictators, but people that were legitimately elected, but then worked to use their position of power to unwind the legitimacy of their free and fair elections. Trump is taking steps along that spectrum, and he's being facilitated by people that don't want to lose money. That's kind of where we are.
Right. Ian, thanks a lot for joining us. Always great to get your perspective. We got to leave it there.
pleasure.
Thank you. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.